Welcome back, everybody, for another deep dive.
Yeah.
Today, we're going to be tackling the world of investing.
Okay.
And specifically, we're going to be looking at Martin Zweig's Winning on Wall Street.
Oh, interesting.
And I know what you might be thinking, a book from the 80s
Right.
in today's crazy market.
Yeah.
But Zweig's insights are surprisingly relevant, even now.
Yeah.
So we're going to unpack whether timing the market is really possible,
Okay.
what separates winning investors from the rest,
Interesting.
and just how much those tiny numbers on the financial pages actually matter.
You know what's really fascinating about Zweig's book?
Yeah.
It's that it isn't just some, dusty relic.
Okay.
He blends market forecasting and stock picking.
Mm-hmm.
So something for both cautious and, active investors.
So there's a little something in there for everybody.
Exactly. And his core idea
Yeah.
is to not fight the natural flow of the market.
Okay.
Be ready to adjust your strategy as things change.
This idea of adaptation is really intriguing, especially coming from someone who witnessed the 1962 crash
Right.
firsthand.
Yeah.
I imagine that experience really shaped his perspective
Oh,
on
absolutely.
risk and volatility.
The 62 crash instilled in Zweig this lifelong respect for market volatility, and he emphasizes avoiding significant losses.
Makes sense.
Yeah.
It's easier to climb out of a small ditch
Yeah.
than a massive crater,
Exactly.
right?
Yeah.
So where does Zweig suggest we even begin navigating this complex landscape?
Well, he starts with understanding these market averages,
Okay.
like the Dow Jones Industrial Average.
Okay. The Dow.
Yeah. Now, while the Dow is widely followed,
Right.
it does have limitations.
Okay.
It's price-weighted, meaning that higher price stocks have more influence.
Okay.
And this might not give the most accurate picture of the overall market,
Especially over time.
especially for those longer-term trends.
Right. So it's like judging a basketball team's performance solely based on the tallest player's points. Important, but not the whole story?
Exactly.
What's a better way to look at the market then?
So Zweig recommends considering broader indices,
Okay.
like the S&P 500,
Okay.
which is weighted by market capitalization.
Okay.
So it reflects the total value of those companies,
Mm-hmm.
giving you a more comprehensive view.
Okay.
And no matter which average you're looking at,
Yeah.
he stresses the importance of adjusting for inflation.
Right.
Nominal price changes can be deceiving,
Really?
especially over long periods.
Yeah, that's a great reminder to look beyond the flashy headlines and dig a little deeper.
Absolutely.
What other factors does Zweig believe are crucial
Sure.
for understanding the market?
Well, he's famous for his don't fight the Fed philosophy,
Okay.
highlighting the Federal Reserve's massive influence on stock prices.
I've heard that phrase thrown around,
Yeah.
but never really understood how to apply it. How
Yeah.
does Zweig suggest we decode the Fed's actions?
So he uses what he calls the Fed indicator, which tracks changes in the discount rate and reserve requirements.
Okay, so can you just break those down a little more
Sure.
for me?
The discount rate is the interest rate that banks pay to borrow from the Fed.
Okay.
And reserve requirements are the amount of cash
Okay.
that banks must keep on hand.
So by looking at these tools,
Yes.
we can get a glimpse into the Fed's thinking and potential impact on the market.
Exactly. It's not about predicting specific ups and downs,
Okay.
but understanding the overall monetary environment.
Okay.
Are they tightening things up or loosening the reins?
Gotcha. So it's like a bull market, bear market kind of thing.
Kind of, yeah. More like, are they making it easier or harder to borrow money,
Okay.
which then affects how businesses operate and invest.
Gotcha.
Zweig also emphasizes consumer behavior,
Okay.
specifically through his installment debt indicator.
Okay. Interesting.
So excessive increases in debt
Mm-hmm.
can signal rising interest rates and potential headwinds for the stock market.
Makes sense. If everyone's maxing out their credit cards, it could spell trouble down the line.
Exactly.
So we're looking at broad market trends, the Fed's moves.
Right.
What about the movement of the market itself?
So
How does Zweig approach analyzing that?
he's a big believer in harnessing what's called market momentum,
Okay.
that force that can really push things in one direction or another.
Okay.
And to measure this, he uses a couple of different ratios.
Okay.
One is called the advance decline ratio,
Okay.
and the other the up-down volume ratio.
So we're talking about tracking which way the market is moving
Yeah,
and the power behind that movement.
exactly. The advance decline ratio compares the number of stocks moving up versus down.
Okay.
When advances consistently outpace declines, say by a 2-to-1 ratio or higher over 10 days,
Mm-hmm.
that's a sign of strong positive momentum.
So when you see that 2-to-1 ratio, It's like the market is leaning heavily
Yeah, in that
on,
direction.
towards the upside in that case.
Gotcha.
Now, his up-down volume ratio.
Focuses on trading volume.
Yeah.
So when up volume surpasses down volume by a huge margin, like 9-to-1 or more,
Right.
that's a powerful signal.
So it's not just about direction, but the force behind it.
The force, exactly.
But isn't there a danger in getting caught up in all this excitement?
Yeah, there's always that risk.
Like, what if everyone's jumping on the bandwagon right before the market takes a nosedive?
That's what Zweig calls fighting the tape.
Okay.
And it's a recipe for disaster.
So how do we avoid that?
Well, he dives deep into what he calls crowd psychology,
Okay.
arguing that excessive optimism or pessimism can lead to predictable market swings.
So when everyone's convinced prices will skyrocket, that might actually be a warning sign.
Precisely, Zweig advocates for a contrarian approach.
Oh.
Buy when the crowd is fearful
Okay.
and sell when they're greedy.
Okay, so go against that gut reaction.
Exactly.
What are some ways to tell when the crowd is fearful or greedy?
Well, one thing he analyzes is mutual funds cash-ous ratio. So when funds hold high levels of cash, that often coincides with market bottoms.
So they're a little hesitant?
Yeah, they're hesitant, they're holding back.
Okay.
Whereas low cash levels can signal tops.
Oh, so they're all in?
They're fully invested.
Okay, so we can look at the behavior of these big players
You can.
to gauge overall market sentiment.
Exactly.
Clever.
He also analyzed this thing called the Investors' Intelligence Sentiment Survey,
Okay.
which tracks the opinions of financial advisors.
Okay, so these are the experts.
Yeah, the supposed experts.
Wait.
And surprisingly, they were frequently wrong
Oh, wow.
about market direction.
So even the experts can be off the mark.
It happens more often than you'd think.
Interesting.
He even created his own sentiment index,
Okay.
which combines multiple measures of this crowd psychology
Okay.
to try to get a clearer picture.
Now, we've looked at market averages, the Fed's influence momentum, and even crowd psychology.
Yeah.
Are there any other factors Zweig suggests we keep an eye on?
He found some really intriguing recurring patterns in the market,
Okay.
specifically around holidays.
Seasonal patterns.
Yeah, seasonal patterns.
Like what, buy sunscreen and summer coats in winter?
No, not quite that literal.
Okay.
But he observed this thing called the pre-holiday effect,
Okay.
where the market tends to rise on the last trading day before major holidays,
Interesting.
perhaps driven by optimism or, last-minute buying or just general human behavior.
I guess everybody's feeling good.
Yeah,
Getting ready for the holiday.
right. But this pattern was surprisingly consistent.
So there might be opportunities to capitalize on these predictable calendar-based trends.
Potentially, though, nothing is ever guaranteed in the market.
Right, of course.
He also highlights the January effect,
Okay.
where stocks often perform well in the first few weeks of January,
Right.
possibly driven by year-end tax selling, followed by buying pressure.
Okay.
And he noticed a similar trend of strong market performance
Yeah.
during the last 5 trading days of any month and the first 3 of the next.
Okay. So pay attention to the calendar.
Pay attention to the calendar.
It seems like Zweig's approach is about weaving together these multiple layers of analysis, understanding the Fed, recognizing momentum shifts,
Yeah.
gauging market sentiment, and even factoring in these seasonal patterns.
It's all connected.
But all of this is just about timing our investments, right?
Right.
What about choosing the right stocks?
That's the other half of the equation.
Okay, perfect. Let's dive into that next.
Sounds good. Zweig doesn't believe in chasing the hottest stock
Right.
or relying on luck.
Okay.
He favors this very systematic approach,
Okay.
what he calls the shotgun approach,
Okay.
where he analyzes a large number of companies
Okay.
to find those hidden gems.
So more of a numbers game
Yeah.
than a treasure hunt.
Yeah, more about being thorough,
Okay.
less about, getting that one lucky strike.
Gotcha. What specific qualities does Zweig look for in a company?
He focuses on fundamentals, things like consistent sales and earnings growth, reasonable price-to-earnings ratios,
Okay.
and solid relative price strength.
Okay, can you just break those down just a little bit more?
Yeah, so price-to-earnings ratio, that's essentially how much you're paying for
Alright.
each dollar of profit.
Okay.
And relative price strength is looking at how well a stock is performing
Okay.
compared to the overall market.
So he's essentially looking for companies that are performing well,
Yes.
reasonably priced,
Yes.
and showing upward momentum.
Exactly. He's looking for those companies that are on the upswing.
That's a skill that would benefit any investor,
Oh, absolutely.
whether you're a seasoned pro or just starting out.
Yeah, it's a fundamental part of investing.
So he's blending that fundamental analysis with this more technical, price-focused approach.
Exactly.
So it's like he's looking at both the engine of the car and how smoothly it's driving.
Exactly. He wants to understand both the company's financial health and how the market perceives its value.
Okay, but even with the most thorough analysis, unforeseen events can impact a stock's price.
Things happen.
Right.
That's why Zweig stresses the importance of risk management, particularly through the use of stop-loss orders.
Makes sense. No matter how confident we are in a company, the market can always throw those curveballs.
Absolutely.
Remind me, how do those stop-loss orders work?
So a stop-loss order instructs your broker to automatically sell a stock if it falls below a certain price. Like it's setting a safety net.
Gotcha. So it takes some of the emotion out of the equation.
Yeah, you're not scrambling to sell in a panic if the price starts dropping.
Right.
It brings discipline to your investing.
Okay, now, while stops can sometimes lead to selling prematurely, Zweig believes they ultimately protect your capital.
In the long run.
Allowing you to be more aggressive when conditions are favorable.
When the odds are in your favor.
Okay, so they're like guardrails.
Yeah, like guardrails.
Preventing those small dips from turning into major crashes.
Exactly.
Now, Zweig is known for successfully navigating both bull and bear markets.
Yeah, he's seen it all.
Does he have strategies for profiting, even when the market is declining?
He does. He dedicates a whole chapter to the power of short selling.
Okay.
Now, it often gets a bad rap.
Right.
But it can be a valuable tool when used correctly.
I'll admit short selling has always seemed a bit mysterious.
Yeah, it can be a little confusing.
And maybe even a little risky.
Well, it does come with its own set of risks.
Can you just break down how it works?
Yeah, essentially you're borrowing shares of a stock that you believe will go down in price, selling them at the current price, and then hoping to buy them back later at a lower price.
To return to the lender.
To return to the lender, exactly. So if the stock drops as you predicted, you profit from the difference.
So you're essentially betting on the price going down.
That's the idea.
Interesting. Now, and I know Zweig emphasizes the importance of avoiding major losses.
Yeah.
But does he have any advice for bouncing back if those losses do occur?
He does, and it goes back to that theme of adaptation.
Okay.
He says, the biggest mistake investors make is being too stubborn.
Oh.
They hang on to losers too long and sell winners too soon.
Mm.
He encourages taking a step back, reassessing your strategy, not being afraid to cut your losses and move on.
It's that classic sunk cost fallacy.
Exactly.
We're so emotionally invested in our past decisions, even when the evidence suggests it's time to change course.
It's hard to let go sometimes.
So Zweig believes in analyzing the market, choosing stocks carefully, and managing risk. But how does all of this come together in practice?
Okay.
Can you walk me through an example of how he actually picks a winning stock?
Let's look at a company that caught his eye back in the 80s.
Okay.
Medical.
Okay.
They manufacture and distribute orthopedic products.
Medical supplies, not exactly a flashy tech stock.
Right.
But essential nonetheless.
Yeah, they provide a necessary service.
What does Zweig see in them?
Well, he noticed consistent earnings growth, zero debt, and something called insider buying.
Okay, insider buying.
So that's when a company's executives purchase their own stock.
Okay.
Often a strong signal of confidence.
Yeah, they're putting their money where their mouth is.
Exactly.
So those with inside knowledge are betting on the company's success.
Right, they're putting their own skin in the game.
Gotcha.
So Zweig bought the stock in 1980, sold it for a profit in 81, and then bought it back in 82 at a lower price.
Interesting.
The market was still in a bear market, but Durfalauer was showing resilience, strong sales and earnings, exceeding their long-term averages.
So he saw value even when the overall market was gloomy.
Right. He wasn't afraid to go against the grain.
And I'm guessing this second purchase paid off.
It did by early 1983. Durfalauer had more than doubled in price.
Wow.
Outperforming the broader market significantly.
Okay, so he really hit it out of the park.
Yeah, it was a great example of his approach.
This focus on underlying value reminds me of another concept Zweig discusses.
Yeah.
Identifying opportunities in what he calls neglected industries.
Right. He sees potential in sectors that are temporarily out of favor,
Okay.
but poised for a turnaround.
Gotcha. So think of it like finding a beautiful antique
Yeah.
hidden away in a dusty attic.
Exactly.
Nobody's paying attention to it.
Right, but it has inherent value.
So these are the value stocks.
Yeah, these are the value stocks.
Companies with solid fundamentals.
Right.
That the market might be undervaluing at the moment.
Undervaluing because they're not the hot new thing.
Right.
But they have strong underlying businesses.
One example he gives is Mid-Atlantic banks.
Oh, yeah.
A regional bank he recommended in 1984.
Interesting.
Now, the banking industry was facing a lot of challenges at the time.
Right. This was during the savings and loan crisis.
Okay.
And a lot of banks were trading at low price-to-earnings ratios.
Because of concerns about bad loans?
Exactly. There was a lot of uncertainty,
Right.
fear in that sector.
So what did Zweig see in Mid-Atlantic banks that others missed?
Well, he recognized their solid track record,
Yeah.
minimal risk of those problematic loans, and most importantly, their bargain price.
So he was looking for those diamonds in the rough.
Exactly.
And did this pay off for him?
It did within a year.
Okay.
The stock had doubled.
Wow.
Proving that sometimes those unloved sectors can offer the greatest returns.
Okay. It's like finding that hidden treasure.
Right.
Now, we talk about how Zweig uses stop-loss orders to manage risk, but how does he actually apply them in real-world situations?
Yeah.
Can you give me an example?
He describes this case involving MCI Communications,
Yeah.
a telecommunications company he recommended in 1982.
Okay.
And his timing was impeccable.
Okay.
He bought just weeks before the market bottomed.
How?
And his stock pick was spot on. MCI had a phenomenal run.
So where's the risk management lesson here?
Well,
It sounds like he nailed it.
yeah, he picked a winner,
Yeah.
but he used a stop-loss order.
Oh.
That was a bit too tight.
Okay.
So the stock had this brief pullback,
Mm-hmm.
which triggered his stop.
Okay.
And he was forced to sell at a small loss.
Oh.
And then, of course, MCI took off,
Ow.
and he missed out on those significant gains.
That must have been frustrating.
Oh, I'm sure it was.
So even when you pick the right stock, a poorly placed stop loss can backfire.
It's a delicate balance
Right.
between protecting your capital
Yeah.
and giving the stock room to breathe.
Right. You don't want to get shaken out by normal market fluctuations.
Exactly.
It's like setting your car alarm to go off if a bird lands on the hood.
Yeah, too sensitive.
What other examples of stop-loss strategies does Zweig share?
He also discusses this concept of a trailing stop,
Okay.
which is a dynamic stop loss
Okay.
that adjusts as the stock price moves.
Okay, so how does that differ from a regular stop-loss order?
With a regular stop loss,
Yeah.
you set a specific price.
Right.
If the stock falls below that price, it's automatically sold.
Okay.
A trailing stop is a bit more flexible.
Okay.
So imagine setting your stop loss at a percentage or dollar amount below the stock's current market price.
Okay.
As the stock climbs, your stop price rises with it,
Okay.
locking in profits along the way.
Okay.
But if the stock starts to decline,
Yeah.
your trailing stop triggers a sale,
Okay.
preventing you from losing too much of your gains.
So it's like riding a wave.
Yeah, like riding a wave.
Letting your stop follow that upward trend.
Exactly.
But ready to pull you out if things start to crash.
That's the idea.
Does Zweig give any specific examples of using trailing stops?
Yeah. He describes a case involving First Data Resources,
Okay.
a financial services company he bought in the mid-'80s.
Okay.
And he set his initial trailing stop below the stock's recent lows.
Okay.
So protecting his initial investment. But as the stock climbed,
Yeah.
he gradually raised his trailing stop,
Yeah.
locking in profits.
Okay.
Eventually, First Data Resources was acquired by American Express,
So
allowing Zweig to sell at a substantial profit.
that's a great example of how trailing stops can help you ride a winning stock while still mitigating risk.
Exactly.
It seems like Zweig's approach is all about combining these different layers.
It is.
Understanding market trends, choosing stocks strategically, and managing risk effectively.
Absolutely. It's a holistic approach.
He emphasizes being disciplined, flexible, and patient,
Right.
adapting your strategy as the market changes.
The market's always changing.
We've covered a lot of ground here,
We have.
from decoding the Fed's actions to navigating the complexities of short selling and mastering the art of stop-loss orders.
Right.
Zweig's book offers a wealth of knowledge for any investor.
It really does.
And while specific stock picks and market conditions may change,
Yeah.
these fundamental principles remain timeless.
I think that's the key takeaway.
Absolutely. Let's take a moment for our listeners to absorb all this valuable information.
Yeah, take a deep breath.
Before we wrap up our deep dive into winning on Wall Street.
Sounds good.
Right, we're back for the final part of our deep dive into winning on Wall Street.
We've covered a lot of ground.
Yeah.
From market timing, the Fed's influence, stock picking, risk management.
Zweig packs a lot of wisdom into this book.
He does.
But if we had to boil it down, what are those core principles that separate the winners from everyone else?
That's the big question, isn't it?
It is.
We've touched on a few already.
We have.
Adapting to changing market conditions, not fighting the tape, understanding crowd psychology.
Right.
What else does Zweig emphasize?
Well, one of the things I noticed was discipline.
Discipline, yes.
Sticking to your system, avoiding those emotional decisions, not getting swept up in those hot stock tips.
Wait, oh yeah, it's so easy to get caught up in the hype.
It is.
But discipline is what keeps you grounded.
Especially when the market is swinging wildly.
Right.
And everyone seems to be making money except you.
Yeah, you got to stay focused on your own plan.
How do you stay disciplined when that fear or greed kicks in?
Zweig reminds us that, successful investing.
Yeah.
It's a marathon, not a sprint.
Oh, I like that.
It's about making calculated decisions based on sound analysis, not reacting impulsively to short-term market noise.
So staying focused on the long game.
The long game.
Even when things get a bit chaotic in the short term.
Exactly. Tune out the noise.
And I can see how that ties into his emphasis on avoiding those major losses.
Oh, absolutely.
That can really set you back.
Those big losses can be devastating.
And Zweig has a really interesting perspective on losses.
Oh, yeah.
He says.
What's he say?
Taking a loss isn't necessarily a bad thing.
Okay.
It's part of the game.
Part of the game. Everyone's going to have losses.
What really hurts, he says, is being wrong and not admitting it.
Oh, yeah.
Clinging to that losing position.
Right.
Because your ego won't let go.
Yeah, pride can be a costly thing in investing.
It's so easy to get emotionally attached to our investments.
Oh, it is.
Especially when we've done all our research.
Yeah, you think you're right.
And you believe in the company.
And you got that conviction.
But sometimes the best move is to cut your losses and move on.
Yeah, sometimes you just got to say, uncle.
Recognize when your initial thesis was wrong.
And that's tough to do.
It is.
But it's a key part of being a successful investor.
Zweig encourages investors to be honest with themselves, recognizing when they're wrong.
It's all about self-awareness.
And not letting pride cloud their judgment.
Right.
So it's about having that flexibility to adapt and change course when needed.
You got to be able to pivot.
That adaptability seems to be a recurring theme in Zweig's approach.
It is. He's not advocating for this rigid, set-in-stone system, but rather a framework that allows for adjustments as the market evolves.
Because as we've seen, the market is always changing.
Oh, yeah, constantly in flux.
He emphasizes the importance of developing your own investment philosophy.
Your own philosophy.
And strategies.
Right.
Something tailored to your individual risk tolerance.
Right.
And financial goals.
Because what works for one person might not work for another.
That makes a lot of sense.
It does.
We all have different financial situations.
Absolutely.
Different levels of experience.
Different goals.
Different comfort levels with risk.
Risk tolerance is huge.
There's no one-size-fits-all approach to investing.
Nope. You got to find what fits you.
It's about finding what works for you.
Exactly.
Understanding your strength and weaknesses.
Play to your strengths.
And developing a system that you can stick to.
That's the key, consistency.
This has been a fascinating deep dive.
I really enjoy it.
Into winning on Wall Street.
Yeah, Zweig's book is full of insights.
It is.
That are surprisingly relevant.
Surprisingly relevant.
Even today.
Even today.
It's a testament to the enduring power.
I agree.
Of understanding those market fundamentals.
Right.
Human psychology. And the importance of adapting to this ever-changing landscape.
Absolutely.
Yeah.
So as we wrap up, what's one final thought-provoking question our listeners can ponder as they continue their own investing journeys?
Let me see. So Zweig wrote this book before the rise of high-frequency trading and algorithmic investing. How do you think those factors might impact his strategies today?
That's a great question.
It's a whole different world now.
It is a different landscape now.
With technology playing such a significant role in the markets.
It would be fascinating to see how Zweig would adapt his approach to this new era.
Maybe that's a deep dive for another day.
Maybe that is.
There's always more to learn and explore.
There is.
In the world of investing.
A huge thank you to everyone.
Yes, thank you.
For joining us on this deep dive into winning on Wall Street.
It's been a pleasure.
We hope you've gained some valuable insights.
Absolutely.
Maybe even sparked a few aha moments.
We hope so.
Remember, investing is a journey, not a destination.
It's a marathon.
Be curious.
Stay curious.
Be informed. And most importantly, be confident in your own approach.
Trust your gut.
Happy investing, everyone.
To your success.